3,500 trades, $695 million, a 45-day reporting delay. Most people think this is just a political scandal. I think they are missing the bigger story. This is actually a masterclass in how information asymmetry works in modern markets. I am pointing out this structural flaw because it shows exactly how the game is played behind the scenes. The impact is that by the time a headline hits your screen, the smart money is already positioned, leaving you reacting to history while Bitcoin prices and the macro shift. But here's what almost nobody realizes. You are not just losing to faster traders. You are competing in a system where critical information often reaches different participants at different times. To adjust your position, you must stop reading the daily news and start tracking the underlying data flows. The final conclusion here is that the game is not just rigged by capital, it is rigged by time. You probably think you can catch up by reacting faster to the news. That 45-day delay creates a massive transparency gap where you are trading on old information while institutions hold a significant head start. But here's the uncomfortable truth. You cannot beat a structural time lag with faster clicking. I bring this up because this is the exact reason Bitcoin can begin repricing macro expectations before the broader narrative reaches most retail investors. Your brain is wired to react to headlines, but the market is wired to reward those who see the data before the headline exists. You have to accept the lag and stop fighting the news cycle by shifting your strategy to track real-time on-chain liquidity instead. The bottom line is that your only defense against delayed public information is real-time private data.
Now we get to the question everyone is asking. Is this insider trading? Researchers see unusual volume before policy announcements, while the defense claims it is just automated index rebalancing. The truth is far more interesting than either side admits. I am breaking down both sides because the market is not actually broken. It is simply operating on an uneven playing field where massive institutions hold superior data and faster execution. But here is what changes everything. You do not need to prove a crime to understand the pattern. The real-world impact is that you will never have their data access, meaning trying to beat them at their own game will only drain your account. Your positioning shift is to stop fighting the insiders and accept their structural edge. The final verdict is clear. Legal information advantage is a major factor driving these prices, and until you understand that, you will keep losing. Most Bitcoin traders think they need to watch Bitcoin charts. That is often the last place institutional investors look. Here is why. A policy announcement shifts bond yields, which shifts the dollar index, which shifts global risk appetite, driving ETF flows, and forcing Bitcoin to reprice. I am mapping out this exact sequence because a shock in Washington instantly hits your crypto portfolio through this direct wire to traditional macro liquidity. But here is the part that should change how you trade forever. Bitcoin is not moving because of crypto news. It is moving because of global money flows. The impact on your trading is that watching Bitcoin charts alone is no longer enough to predict price action. You must adjust your strategy by watching the dollar index and treasury yields just as closely because they are the actual triggers. The key conclusion is that Bitcoin is no longer disconnected. It is just the reflection of global money flows.
Everyone tells you Bitcoin is a hedge against the traditional financial system. That might be the most dangerous assumption in crypto right now. Here's what actually happens. If hundreds of millions rotate into traditional tech, it siphons momentum directly away from Bitcoin, while direct political ties to specific crypto projects create unpredictable regulatory risk. I am highlighting this downside because deep correlation means a traditional market shock will drag Bitcoin down with it, destroying the myth that it is an automatic safe haven. But here's the real kicker. As Bitcoin becomes more integrated with institutional portfolios, it increasingly reflects some of the same macro risks affecting traditional markets. The risk of doing nothing is getting caught in a massive sell-off when traditional finance sneezes. How to position for the fallout is to stop treating Bitcoin as a disconnected hedge and actively hedge your crypto portfolio against traditional market volatility. The ultimate takeaway for this section is that as Bitcoin grows, it inherits the macro risks of the legacy financial system.
You cannot outtrade the insider. But what if you could track their footprint instead? Here is how. Stablecoin exchange movements, unusual options volume, prediction market spikes, and macro levers like the dollar index. I am giving you this specific checklist because the market price is in the move long before the news explains it, leaving retail traders holding the bag if they wait for headlines. But here is where most people fail. They set up the alerts and then ignore them until it is too late. The impact of using this plan is that you will spot institutional hedging and liquidity shifts before the price actually moves. Your immediate action is to set alerts for these 4 triggers and immediately lower your leverage and tighten stop losses when they fire. The survival mandate is to track the data flows because waiting for the news means you are already too late. The debate over 3,500 trades is just a symptom of a much larger machine, but most traders will never see it because they are too focused on the asset itself. I am saying this because your long-term survival requires shifting your focus from Bitcoin to the global liquidity system driving it, which stops you from getting trapped by sudden price drops. Here is the mindset shift that separates professionals from amateurs. Stop asking, what is Bitcoin doing? And start asking, what is global liquidity doing? The impact of this mindset shift is that you start anticipating market moves using traditional data instead of reacting to crypto-specific panic. Your final positioning move is to stop treating Bitcoin as an isolated asset and start treating it as a global liquidity sponge. The structural reality is that your only real edge in this game is having better information than the next person.
You need a system that feeds you real-time execution alerts without a 45-day government delay. Why? Because the retail crowd will always be reading yesterday's news, and by the time you understand what happened, you are already exit liquidity. I am sharing this because falling behind the information curve turns you into the person insiders use to take profits. The real-world impact of joining is getting forensic macro analysis exactly when it matters, keeping your capital safe while others panic. Your immediate action is to join the Axiom Intelligence private community via the link below. If you're finding value in this forensic breakdown, please like, share, and subscribe so you never miss a real-time alert, and drop a comment on whether Bitcoin is still a decentralized hedge. The final rule is simple. In a market where insiders have the edge, your only advantage is information, so stay forensic. Axiom Intelligence Specialist Desk. High-conviction crypto intelligence. Vetted institutional execution protocols. Normally $62.49, now $49.99 per month. Save 20%. Includes a 3-day trial for $5. Link in the description.